Welcome to this FinBot Insights Explainer. We're going to tackle a tough question today, one that a lot of income investors are probably wrestling with. What do you do when that high-yield investment you bought for income starts to go down in value? So here's the scenario. That high-yield ETF you own is bleeding. What now? We're diving into that really tough choice you have to make, managing a losing position in a covered call ETF. It's this constant tug of war, isn't it? The income you need right now versus making sure you're not losing your initial investment over the long haul.
All right, to really get what's at stake here, we have to talk about the core problem, and that's something called NAV erosion. It's a bit of a trap, really. This is what happens when a fund's distributions, the money it pays out to you, are actually higher than its real economic return. So what does that mean? It means the fund is basically paying you with your own money and charging you fees for the privilege. Over time, this causes the share price to just shrink. Think of it like a piggy bank that pays you a regular allowance, but that allowance is funded by slowly chipping away at the piggy bank itself.
So let's start by looking at the case for just holding on. We'll explore the argument that frames this high yield not as a problem, but as a deliberate, strategic feature for certain financial goals. You'll hear this perspective a lot. For many investors, holding a losing covered call ETF isn't about giving up, it's a strategic choice. The idea is that if you're someone who absolutely prioritizes immediate and consistent cash flow, maybe you're a retiree, then those monthly distributions are your paycheck. In that scenario, the whole point of the investment isn't necessarily to grow your initial capital, but to cover your living expenses month in and month out.
So the argument for holding on really rests on a few key pillars. First, it gives you that reliable income stream you need to cover expenses without having to sell off your shares. Second, the premiums you get from selling the calls can act as a little bit of a cushion when the market gets choppy. Third, you've got the tax angle. Some of these distributions are classified as a return of capital, which can defer your taxes by lowering your cost basis. And finally, for some people, these ETFs just serve as a dedicated income sleeve, say 20 to 40% within a much larger diversified portfolio.
And it's really important to understand that this NAV erosion, well, it isn't inevitable. It's not a guaranteed outcome for every single covered call strategy. If you look at the data for some of the newer, more actively managed funds like SPYI and QQQI, you can see they've actually managed to grow their net asset value. This really proves that how the strategy is implemented is absolutely crucial. Their active, data-driven approach is a world away from some of the older, more passive models like QYLD. Okay, but for every argument to hold on, there's an equally powerful and disciplined counterargument. And this perspective prioritizes one thing above all else: preserving your capital. It basically says that the structural flaws in some of these covered call strategies are a risk that's just not worth taking.
So what is that flaw? The inherent weakness of any covered call strategy is that it puts a cap on your upside. It's the trade-off you make. In exchange for getting that option premium upfront, you're agreeing to sell your shares at a certain price. That means in a strong bull market, when the stocks are just taking off, you miss out on all those big gains.
And this chart, this really shows you the stark reality of that capped upside. Look at the difference over a decade. The NASDAQ 100 index, tracked by QQQ, delivered a total return of around 460%. Over that same period, the popular covered call ETF on that index, QYLD, returned about 115%. It captured only about a quarter of the growth. That is a massive, massive opportunity cost.
So yeah, let that number sink in for a second. We're talking about a performance gap of roughly 75%. That figure quantifies the immense price an investor paid for holding an eroding asset during a decade-long bull market. This really gets to the core of why proponents of cutting losses are so adamant. It's all about discipline. It's about sticking to that time-tested investing rule: cut your losses short and let your winners run. It's about avoiding behavioral traps like the sunk cost fallacy, that feeling that you have to keep throwing good money after bad just to try and break even. And on a practical level, it frees up your capital so you can redeploy it into assets that are actually growing. And it allows you to use tax loss harvesting to offset gains elsewhere.
So we've laid out two very compelling but completely opposite arguments. It's easy to feel paralyzed, right? But the solution here isn't a simple yes or no. The answer lies in building a structured decision-making framework to move you from that feeling of paralysis into taking deliberate, intentional action.
A professional investor doesn't just react emotionally. They follow a plan. And here is a 4-step framework you can use to evaluate your own position based on your specific situation, not just gut feelings.
First, assess your needs. Is your top priority near-term income or long-term growth? Second, monitor the total return. Don't just look at that flashy yield, track the NAV trends every quarter. Third, diversify your allocation. Maybe limit these covered call ETFs to just 20 or 30% of your equity portfolio. And fourth, leverage the tax rules. If you're in a taxable account, be systematic about harvesting losses to improve your after-tax returns.
All right, we're getting to the final determination. Ultimately, whether you decide to hold or to sell, it has to be a final, intentional decision. You need to be crystal clear about what role this specific asset is supposed to play in your overall financial plan.
And it really all boils down to this one essential question. Is the yield you're getting a real paycheck, or is it just a slow bleed of your principal? Because a high yield without a positive total return is a dangerous illusion. It's a siren song that can lead you straight into the long-term destruction of your capital. You have to be honest with yourself and figure out which one it is.
Now, please remember, this is all for informational purposes. It is absolutely not financial advice. Your first priority should be to not trust social media influencers, and yes, that includes us. Always do your own thorough research. But if you did find this explainer valuable, we'd appreciate it if you click like and subscribe for more.